Right. Interesting point you're making that over a period of time, equity is going to give you very good return. Let me throw that to the other two. Radhika, let me go in reverse direction this time. Radhika, given the fact that the Indian economy is growing the way it is, and it's likely to continue to grow. So if you're seeing, what's it, 6-7% economic growth, then you add inflation to that, then you add corporate earnings will be higher, you could possibly be making 12, 13, 14% in the Indian equity market over a long period of time is what you may expect. Now, there'll be ups and downs, obviously, which is why you've got to be careful. Don't be a short-term investor. But for a long term, if you're investing, would you also be comfortable for a lot of people to have 70, 75% of their money in equity markets? Or do you think that that's too high? And what's your overall take on where you think equity markets are going to go in the next few years?
So look, I mean, I'm as much of an optimist as others on the panel. I think if you look at the last 20 years of equity markets, we've probably delivered about 12% headline equity growth. And Vikram, I would say this wasn't the greatest period for India. We had multiple different parties in power. We had Asian financial crisis, we had global financial crisis, we had COVID. There was so much going on. And I think sitting today, where the Indian economy is, and one of the things that I get most excited about is really the meeting of top-down policy with bottom-up what companies want, which I think, is relatively unique to this era. I think the past is already a golden example and the future could be even brighter. So one, I'm very optimistic. I also think that the last decade for India was a little bit of a lost decade as far as earnings growth. That is turning around. So earnings have finally come and you're seeing the numbers in corporate earnings, you're seeing the numbers in private investment. So I think there are a lot of things to be bullish about.
All right, Dhirendra, your advice at the end of the day, right? Now, fine, I've got X money or I'm trying to figure out what to do with my money. Where do I invest it this Diwali?
I think that, as Radhika was saying, it's very personal. So it depends when you need to really draw from that investment that you are accumulating. If you are still in your early phases of accumulation, have a larger allocation to equity and keep it multi-cap. That is, hybrid is a great way of doing it for any new investor because we keep talking about asset allocation. We keep talking about rebalancing. Doing it is hard. And doing it is, hard, and also it's a difficult decision on many occasions because that is when the market is going up. That is where it automatically happens. If you have chosen a vehicle, aggressive hybrid fund, which is 75% equity, 25% debt, it will keep it going and there will be absolutely no tax incidence. Not only that, given the tax regime that we have for the debt mutual fund, it has become so tax efficient, you don't have to bother about it. You will be liable for any tax or anything only when you realize your investments. And then doing a SWP as and when if you can actually hold a mutual fund of that kind for 20 years, I really wonder that the whole journey could be a tax-free journey for you if you go with a 4%, 5%, 6% withdrawal after you retire.
Housing, gold, silver, under the mattress, keep it in cash. That's been what Indians have traditionally, done. There seems to be a movement to saying, okay, let's put that money into financial assets, let's put that money into FDs, into banks, and increasingly into the equity markets. That's a good trend, right? And it's something that will eventually stand India in good stead and stand investors in good stead. So long as they're not taking wild, risky things, buying crypto and stuff like that.
Yes, you're absolutely right, Vikram. If you look at the Indian households, they have been great savers. If you look at FY22, 46-47 lakh crores of savings in one specific year is not a small amount. Secondly, we are great savers but very bad investors because we have been the largest importer of gold for many, many decades. If gold was in rupee terms, it has given you the return. If you look at the data in terms of 1 year rolling, 2 year rolling, 3 year rolling, 5 year rolling, it underperformed equity significantly and in several pockets underperformed debt as well. In Indian rupee terms, of course, it wears a beautiful jacket, which is the rupee depreciation, gives it 3, 4, 5% Philip. Otherwise, gold as an asset class, if it was a great global asset class, we would have been the richest country in the world by now. That's not the case because gold in dollar terms have stagnated for decades, if not. So from 1979, 1980, when I was born, till 2003, it gave a negative return. So it's only the only asset class I know which can give a negative return in dollar terms for 23, 24 years.
Okay.
So point is, if you look at data, I think physical assets will have lesser merit in one's portfolio. And I think we all should look at data for prudent decision making.
All right, Radhika, before you leave us, any specific advice you'd give? Look, people are concerned right now, right? There's war happening in Israel. There's a war happening in Ukraine. There's a possibility of what's going to happen to oil. Will there be political instability here or not? Yes, the Indian economy is in good shape, but who knows? And people are wondering whether small caps in particular have become too expensive and whether they should be moving it into large caps. So any specific advice you'd give us on stocks or sectors before you leave?
So I think on market caps, I think there's a lot of noise on small cap, mid cap. I don't buy that narrative. I think a lot of the noise is because a couple of fund houses have decided to close down schemes. I think small caps are at the mid, and we run large mid and small cap funds, are at the midpoint of the valuation cycle and at the early point of the earnings cycle. And I don't think the solution is to just run away from mid and small caps, or to move, hook, line, and sinker to large caps. The solution is to take the middle path, which is probably multi-cap. The other specific advice I would give around Diwali, Vikram, I was in Delhi 2 years ago when everyone was rushing to buy crypto asset and every uncle at a Diwali party was asking me this. I would say in this bull market, keep a sane head on your shoulder. Don't fall for the frenzy. Really take the middle path. And with all the global volatility, realize that it is going to be there, but have the ability to zoom out.
All right, Radhika, thank you so much for joining us. Feroz, let me throw that same question to you. What would you be saying in terms of specifics, small caps, sectors that you think are good, infrastructure, defense, whatever it is, and specific things that investors should not be doing?
Yes, so I'll make 2-3 points. I concur with Radhika that small cap is not overdone. So people who believe that small cap is overvalued, they may not have checked the earnings. So the estimate for earnings of Nifty small cap 250s, in our opinion, is 636, give or take, depends on what actually transpires for the rest of the 6 months. On a 12,000 Nifty level, we are still looking at 21, 22 P. So there is still a discount, significant discount to its median valuations it's at.
And broad sectors that you're excited by right now for the next 3-4 years if somebody wants to invest?
Brilliant question, Vikram, because when you look at sectors, you have to be very agile. So long-term sector, I would say pharma. We're going through a structural change in that industry. We were very generic kind of an industry. There is CDMOs creating a lot of innovation there. I personally think 3, 4, 5 years, pharma as a sector, being a little more overweight than it has on Nifty, has the potential to outperform, the pharma index has the potential to outperform Nifty by about 4-5%.
Interestingly, you're saying pharma, which is considered defensive and not the usual infrastructure and other areas that people think are going to be a play on the Indian economy.
Yes, because exiting them is going to be very critical. If you're looking at a long-term sector, is when it becomes an executionable advice. Because I had given an IT call in June, it transpired in 3 months, again it came down. So if you look at sectors which you can stay the course, is when a mutual fund investor can take any actionable from this advice, is why I'm sticking with that.
All right, Feroz, thanks a lot for joining us as well. Bijay Bhambani now coming on as well, promoter Bhambani Securities. But before that, let me just turn to you, Dhirendra. Any other specific advice? And we've done the theory. When you're looking at the markets right now, what are the areas and the sectors and the funds that are standing out for you? Someone has to invest money right now.
I would say that most people still don't have a plan. In fact, the large inflow that we see in mutual fund or through SIP is still a good amount of performance chasing. And I think it's very important or critical for people to work on some plan which has the dominance of equity for the long term. And they should devise that plan and stick to that plan and not get distracted with all the blips that come on in the way. And if one is able to stick around for a couple of years, then you will have a happy Diwali for many years.
That's actually the most important thing for people who are watching this to take away. the best way perhaps to make long-term money for yourself is by investing in the equity market and doing it for a long period of time. This is what we began by saying. But, and it's very important, there's a very important but in this. The but is that doesn't necessarily mean you're going out there and trading in stocks or buying and selling shares or buying individual stocks yourself. As Dhirendra just said, 90% of people will burn their fingers in doing that.